Okay, good evening. My name is Peter Rezicek from shadowtrader.net, and this webinar is called How I Trade Weekly Options. So, if you are new to weekly options, what are weekly options? Weekly options are simply options that expire every Friday in addition to the usual third Friday of every month. So, this is important. They expire every single week as opposed to just once a month. Important to note that not all stocks have weeklies, but there are hundreds of them that do. And there are about 90 ETFs that have it and about 520 stocks that have it. So obviously in the universe of equities that are out there, it's a relatively small percentage that has them. And if you want to have the entire list, you can go here to cboe.com/available weeklies for the complete list. All right. You may have to refresh the page. You guys can't hear me again? Is it okay? Sounds good, right? And you should see the video. What are weekly options? Okay, we're good, right? Okay. If you're not seeing me or hearing me, just refresh your page. You should be fine. Okay, good. All right. Now, if you're new and you're just looking into weekly options for the first time, understand that open interest and volume is a factor. Even though you have all these stocks that are trading weeklies, not all of these weeklies are created equal. So this is important. Some of them have very low open interest and also have very low volume. And this is important for the discussion that we are having today, because we're going to be talking about complex spreads, not just putting on single options. We're going to be talking about spreads. And when the option has low open interest or low volume, then it is relatively difficult sometimes to fill a spread when you have low volume. Some of these options can have very wide spreads as well that are $1, $2, $3, and that makes it very difficult to put on, say, like a Butterfly or a BWB or something like that in that type of stock. So be very careful and be very selective when you are trading weekly options. And a good rule of thumb is try to find weekly options that have very high open interest and high volume as well. Okay. Why do I like weeklies so much? Because they present lots of asymmetric opportunities. And what is an asymmetric opportunity? An asymmetric opportunity is simply one where there is a huge delta, if you will, between potential risk and potential reward. Huge difference, right? Where you can basically risk a little and make a lot. That's like an asymmetric opportunity. And why do weekly options specifically create asymmetric opportunities? Well, for a number of reasons. Firstly, there's a much shorter time to expiry. We're dealing with options that are expiring in 7 days or less. Sometimes we might be putting them on in the series before, meaning we're looking at, like, say, 12 to 14 days to expiry. Sometimes we're putting them on 1 day before expiry, and sometimes we're actually putting them on the day of expiry, okay, which is really short. Right now we're talking about an expiration that is measured in hours rather than days. And this, I believe, makes it somewhat easier to predict future price because you're looking at a much smaller window. For example, if I asked you to predict the price of Apple in a year, you'd probably have a very difficult time. The odds of getting it right would be very, very low if I said, where's Apple going to be 365 days from now? But if I was having that discussion with you on a Wednesday and I said, you know, where do you think Apple's going to be on Friday? And if Apple was at 175 on Wednesday, well, you could easily, you know, make the argument and say, well, I think 177 or maybe 172 or whatever. And you have decent odds that you might be correct, right? As opposed to doing it a year out. So that's definitely one factor that makes it very attractive. The next factor is that you have a much, much faster theta burn. If you're looking at about 2 weeks to expiry, that's where theta really starts to accelerate downward. Remember that theta doesn't look like this. It's not a straight line at all. The theta burn, when you come into about 2 weeks, looks kind of like this, and it drops down precipitously like that. And this is about 1 week here, and this is 2 weeks. And you can see here, it starts to fade away, and then it really kind of accelerates to the downside very, very quickly. So what we're doing is we're trying to leverage this very, very fast theta burn, which is important. Okay, so that's point number 2. And point number 3 is that you get is potentially very explosive appreciation when you have very short dated long options of when they're going in the money. And this is important to note, obviously, right? This is where you can really, really maximize gains, where you're looking at stuff that might be trading for pennies a couple days before expiry, but is trading for dollars on expiry because portions of that spread have gone in the money. And this is super duper important. And be aware that what I'm discussing here is not buying single options for pennies and trying to sell them for dollars. We're talking about spreads. We're not talking about buying like far out of the money, lottery ticket calls for 5 cents and then hoping they go in the money for multiple dollars. And that's not what this is about. You'll see in a moment what this is about in a second of how we're going to approach this. All right. So those are some of the reasons why basically I really like weeklies. All right. Leveraging the power of time by being net short. This particular slide is really the most important slide of this entire presentation. Okay, it is the most important slide of the presentation. If you can understand this concept, then you can really harness the power of the weeklies, and it can be very, very lucrative for you. So what do we mean by being net short? We harness the power of short time to expiry by being net short, but net short doesn't mean naked short. That's important to note, right? What is a naked short? Let's say, again, in our Apple example, Apple is trading at 175. You don't think it's going to 180, so you sell the 180 call by itself. You're just short the 180 call. That's a naked short. We're talking about being net short. What is net short? Net short is when we create structures or spreads where we are either selling more structures than buying, or we are using spreads where we are selling wider structures than we are buying. So for example, the broken wing butterfly. This is our first example of the 3 different spreads that I use all the time in my own trading and weekly options advisory. And it is the first example of the type of spread that is net short. As a matter of fact, it is the primary and sort of first example of how you would construct a spread that is net short. So for instance, how is the BWB structured and how is it different from a regular butterfly? If this one here on the left is a regular butterfly, we know that there is equal distance between all of the strikes. Whereas in a BWB, the distance is not equal. You have essentially a long vertical here and a short vertical here that's wider. And let's just say, for sake of argument, that this one is 15. And let's say that this one is only 5. And these are equal. You can see this one is 5 and this one is 5. And because of their structure, they are different in price, and they are very different in characteristics. For instance, the regular butterfly is always a debit. You will never, ever get the butterfly for free. It will always trade for a debit. So you always have to pay for this structure. The max value of this structure will always be at its short strike. That is true. And your risk is limited only to the price you pay. So if you buy this butterfly for $1, the most you can lose is $1, because any price underneath it makes it worth 0, and any price above it also makes it worth 0. The broken wing butterfly is a little bit different, because Certainly it can be bought for a debit, but what makes it very exciting is that it can be bought for a credit or zero. And this is very, very important to understand when you are trying to take on risk to go directionally. Think about that for a second. You make money in the options market only two different ways. You're either, actually, let's say three different ways. You're either right on direction, you're right on time, or you're right on volatility. Options players basically try to guess one of these three things. Direction, meaning it's going to go from point A to point B. Time, meaning I'm going to be short this and it's not going to go there. I'm just going to run out the clock. Or I'm going to put on something in a period of high volatility and I'm going to take it off in a period of low volatility, or vice versa. All right. So this is important to note that this is the first of many of three structures, I should say, that we're going to talk about that are going to be being able to be put on for a credit or zero and still be directional. All right. Max value is still in the middle. We know that. And because we're getting all these extras here of being able to put it on for zero or small credit, the risk profile is slightly different. All right. The risk is greater than the purchase price, but it is defined. So obviously there's a little bit of risk. All right, so understand that, because remember, there's no free lunch on Wall Street, so to speak. For any situation in the options market, generally, when you're dealing with complex spreads, the moment you start to decrease your price, you are increasing your risk in some manner. So just understand that as we go through these different examples, remember that there's nothing free. All right, just very, very important to know. Okay, so given the broken wing butterfly, let's look at a real life example of how this would how it would play out, okay? And when looking at the two spreads that we just looked at, which is the regular butterfly and the broken wing, let's look at some points here as to why one is better than the other. The broken wing leverages the power of time with a wider vertical sold against the narrower one bought. We know that to be true, right? Because obviously if we sell a wide vertical and buy a narrow vertical, that's what gets our cost down to zero, all right? It can win in three ways, either up, down, or sideways. That's important to note. Can be placed for a credit and then closed for another credit. Happens all the time. Those of you that follow my weekly options advisory, you know that I do this all the time. It is a far lower cost, often zero or credit, which means, and this is important, being wrong on direction does not lose you money. So let's just say we had this structure again, like we were saying on Apple, and we thought Apple was going from 175 to 180, and we put on the 180, 185, 195 broken wing butterfly, and we paid zero for it because we had a wider vertical sold on top than the more narrow one we paid for on the bottom. And what if Apple just didn't move and it stayed at 175? Well, instead of paying for a vertical or buying the stock, we didn't lose a penny because our cost was zero. All right. That's approaching it directionally. Now, it's important to note that the BWB can also be used as a credit collection vehicle. And this is very important, this last part. It's very forgiving as opposed to a short vertical if you use it as a credit collection vehicle. So think about this for a second. If you have a spread that you can put on for a credit that actually has a long in front of the short, and you're going this way towards it, aren't you going to sleep better at night with this structure, right, than you would with this structure? If price is going down here towards your short of your vertical, you're going to obviously sleep much better, right? And this is also going to react much better to the downward price going towards it because the first option that it's moving to is a long option, and you've got this other option down here. So really all that's happening is that it's going to be basically a longer vertical that's going against you and a more narrow vertical that's going for you. And that's really, really important because, again, it's going to make it much, much more forgiving in terms of how it's going to react day by day if you were using it as a credit collection vehicle. And the example that I'm about to show you, which is a real life example that we did just recently, is a directional example. But just so you know, we do use this spread as a credit collection vehicle all the time. Okay, let's get into an example. Okay, so this is the trading blotter from Weekly Options Advisory, and we track every single trade here as it happens daily. Everybody has access to this. We email this out to subscribers every evening. It's also posted in our pro trading room, which is the room you're in now, but this is a side webinar room, but this is essentially what it looks like if you were to be a member of our room. And the example I'm going to show you is with Tesla, and it's the one obviously that's circled here. And before I get into the details of it, pay attention to just these two columns here, which would be this one here, and this one here. These two columns here are the date that it was actually entered or taken off, and these here is the expiry. So understand that we are talking about a December 17th expiry, and we put the trade on December 13th. And if you look at the details here of what it was a put broken wing butterfly, which was a 920, 900, 870. And our cost was 15 cents right here. Okay, we paid 15 cents for that. Let's take a look at a chart so you can better understand the ideology of why this was a trade and why this made sense. All right, here's a chart of Tesla daily. And I've purposely put an arrow on the exact bar where we entered, which is December 13th. And understand that everything that I do in trading these weeklies, week in and week out, my own account, advisory, everything, it's all about technical analysis. Understand that everything that we are talking about here has nothing to do with probability or guessing or do we, is the mid strike the 30 delta option? None of that. It all has to do with technical analysis. So in this case, on December 13th of just last year, this is just a couple of weeks ago, I was pretty sure that at some point, preferably by the end of that week, Tesla was going to float down to the 900 level. It was going to test the 900 level because you don't see it in this chart, but it was a breakout level. There was strong resistance at 900 before that the stock had difficulty getting over, then it gapped up above it. And I knew that the price action was basically going to just be slowly coming in to the 900 level. And so if you recall from the prior slide, what did we do to potentially exploit this price action of just these few days coming into 900? Well, we bought the 920 call, we sold 2 of the 900 calls, and then we bought 870, and that's broken wing, obviously, because this is 20 points and this is 30 points. And notice the price. We paid 15 cents per contract. So it's almost free, not completely free, but almost free. Paid 15 cents a contract. And if you'll note, we have a potential max value of $20. Okay. Now the stock in this case, before we expired, never made it to there. The expiry was on the 13th, 14th, 15th, 17th was here. You can see we never made it down below 920. You can see the stock right here closed probably above. But because of our structure and because the stock was moving in the direction that we were going, notice what our exit was. The spread expanded to $1.50, and we were able to close it for 10x. This is 10 times the cost. We paid 15 cents, And by the end of the week, even though we didn't go into the sweet spot, we closed the spread for 10 times what we paid. And we could not have done that with a straight butterfly because it would have cost a lot more. And in this particular example, because we were very confident about the 900 support, it made sense to structure something like this where we were okay being a little bit more short under 900 and having our long above 900. All right. So this is a perfect example of how the BWB can slowly expand its price in your favor, even if you don't go to the sweet spot by the time of expiry. You don't have to do that. And that's something that's very important to understand in the way that I trade. Nothing that I do has a binary event to it, meaning I don't look at this as home runs of like, oh, well, I'm going to buy it for 15 cents and it's going to land on 900 at the end of the week and it's going to turn into $20. It doesn't work that way. In this particular example, the spread was purchased for 15 cents and we sold it for $1.50. That's 10 times the cost. And remember, and these options are relatively liquid. You could have 20 on, 50, 100. It doesn't matter. And this is just a example that's happening in the weekly option advisory where I use relatively small size so that everybody can follow along. Our model is basically anywhere from 1 contract up to 8 contracts. All right. This one happened to be 1 contract. I think if I remember properly, we were looking to add more of them, but we had a bunch of trades on and we never added to the trade. But the example is still extremely valid. It doesn't matter the size of it. It still, really shows the power of how much these things can expand in your favor if you are right on direction and you're also right on time. And in this case, what's also very noteworthy about it is, remember, we didn't have to be too right even if we weren't, because it was a 15-cent debit. Now, granted, you don't want to just throw away 15 cents, but again, the price is very, very close to zero and was able to expand about 10x. Okay. Let's move on. The next type of spread that I want to talk about, and we're kind of going sequentially here. If we start with broken wing butterfly, the next spread that I use all the time is called unbalanced butterfly. And I've drawn it both ways here, if it was calls or if it was puts. And obviously one is going up and one is going down. And so if it was calls, you would be long 1, short 3, and then long 2. And if it was puts, you're going in this direction. You're long 1 up here and short 3 and long 2 down there. Just a question of direction. It's the same characteristics in terms of cheap price, expansion, et cetera, just like the BWB, but even more so. It's kind of like the BWB on steroids. Think of it that way, because you have 3 shorts now for every 1 long. And this one offers extremely massive leverage of time, which makes sense, correct? Because think about it. If time is very short, let's say you have 2 days to expiry and you're on the call side. Well, remember what we talked about, the BWB simply being 1 long vertical and 1 short wide vertical. But in this case, it's 1 long vertical and 2 short verticals. And these can be equal with, or they don't have to be. You could push this out as far as you want, and you could make it unbalanced BWB. It doesn't matter. But the leverage of time comes from this simple fact that you've got 2 short verticals and only 1 long vertical. So given that, you must use caution and you must use precision. You have to really have a good handle on your short-term technical analysis to understand when and how to do this. All right. Let's look at an example of the unbalanced. And this one is in Lulu. And again, I invite you to pay attention to these 2 columns here so you know the dates. So this is an August 27th expiry. And we put the trade on August 25th, and then we took it off on the day of expiry. So August 25th, 2 days before. And you can see here, we bought 8 units. And what was our cost? Our cost was 0. We bought the 410 call. We sold 3 of the 415s, and then we bought the 430 in a 132 structure, which is the unbalanced butterfly, and we paid 0. And let's take a look at the chart and see why we did that, why that makes sense. So this is Lulu at that time, August 25th. And again, everything is technical. Everything has to be technical. Where is resistance on the stock? At 415. We know we've got a prior top here. We've got very short time to expiry. Here's what we did, right? Bought 8 units of the 410, 24 415, 16 430s, and look what price did. 2 days later, this is our expiry right here. Notice that we never went to our target. This bar here is actually the expiry, not this bar. It would be great if it was this bar. It's actually this bar 2 days later where we expired. And how did we close it? Remember, we paid 0. We sold the 410 call 2 days later for 70 cents. And obviously, we just let all the shorts just expire. And before you start screaming, oh my God, what about the margin? Well, remember, you only have hours until expiry, so you can handle it. All right. Yes, you might get an ugly message at the bottom of your screen or whatever, but at 4 p.m., everything's going to be fine. And I believe, if I recall, I mean, it was so long ago, but sometimes it just makes sense just to sell the call itself rather than try and fill the BWB, because at that point, a lot of the stuff that was up here, the 415s and 430s, they are more than likely 0 bid, and it might be more difficult to fill, which is fine. So in this case, we were able to just sell out the 410 call, which at some point, probably in the morning of August 27th, was still trading for 70 cents. And again, we put the structure on for 0, which is fantastic. So it's basically an infinite percentage profit. We paid nothing and we sold for 70 cents. All right. So that's a very good example of how a BWB can work and how powerful it can be. All right. Let's go to our next example. This is the last spread that I want to share with you. This is the spread called ratio, and it is the most powerful and versatile of the spreads that I employ. And it can really be employed in almost all situations, with the caveat that it can eat up a lot of margin. But that can always be adjusted to a BWB. So yes, it can eat up a lot of margin, but remember, you can always cap off that risk as a broken wing butterfly. So for example, if you have a ratio spread on the call side, and a ratio is nothing more than buying 1 and selling 2, and this is actually a typo. This little plus sign shouldn't be here. It's actually +1 - 2. So you have +1 - 2. Obviously, because you have 1 extra naked call, that will be margin intensive, but you could go way up here and just cap it off and turn it into a BWB. And you can put this so far out that maybe this trades for like 5 cents or something and really has no effect on the profitability of your spread other than to cap off the margin. All right, so understand that. Ratio spreads are also excellent for credit collection. They really are. They're absolutely fantastic for credit collection. Similarly to the same reason that I said that broken wing butterfly is great for credit collection. Why? Because it puts the long in front of the shorts. You simply sleep better at night knowing that the long is in front of the shorts. It just makes perfect sense. And remember, if you're doing it for credit collection, it can win both ways. If you sell a vertical or a naked put, you don't want price to go down anywhere near it. You want price to stay as far away from it as possible. But if you were moving down into this structure, and now price is coming down here, well, it's coming down towards a long put. And what if price finishes in here somewhere? Well, this put now has intrinsic value in the money, and this one goes to 0. Excuse me. So it is great for credit collection as well. Last point, extremely powerful for a directional trade. And this is also really can get very, very exciting. Think of the shorts as financing your long instead of seeing them only as risk. And I want to just repeat that because this is a question that I get most often, and most people who understand options are watching this and they are rightfully thinking of the risk. You are correct. There is risk here, without a doubt. You are naked in option, but you do have a very wide, many times, long vertical in front of it. And you will not be successful in ratios if all you think of is the risk. You'll be more successful in ratios if you think of the shorts as their function of financing the long. When I put on a ratio, I do understand the risk, and I am very, very cognizant above the risk, or about the risk rather. But I am far more excited about the fact that it's giving me a call option or a put option for free. And that's really important to note. So you can use this not only as a credit collection vehicle that I think is superior to vertical or naked option, but it can also be used as directional, and it can be very exciting as a directional. All right, so let's look at a real life example of that. This one is Amazon from about a month and a half ago toward mid-November. And you can see the dates here. We started putting it on the 12th, and we took it all off mostly a couple of days before expiry. The expiry was on the 19th. And what was the trade? We had a call ratio that was 3,700 to 3,780. So in this example, we were buying 3,700 calls and selling 2 times 3,780 calls. And we did that actually six units. We did it 3 times. If you can see right here, we did it twice, and then twice again. And the first time we did it, we got $1 credit. And then 3 days later, we put the spread on again, and we got a 40-cent credit. And then that same day, we put on 2 more, and we did it for 0. So notice also that as time advanced 3 days, price wasn't as good, right? Makes sense because the 3,780 shorts were worth less then. So, we got $1 the first day, 40 cents the next day, and then we did it for 0. All right. Now, why did we do that? What did the chart look like at the time? Let's take a look. Okay. Amazon. Look at the first arrow, November 12th, when we put it on. Correct? And what did we say our spread was? 3,700 to 3,780. And let's just take a look at where we're at. Price was here when we entered. Here is 3,700. Let me do this in white. Here is 3,700. And we bought 6 3,700s and we sold 12 3,780s. And again, everything has to be technical. Why would we put on this particular structure? Well, where's resistance in Amazon? 3,780. 3,773 actually was the peak right here. So obviously, if we are opening a spread here with about a week to go, the idea was, well, I think it could take a big leg higher. I don't know how far. I don't want to pay for it, but I want to really maximize. I want to get a lot out of it if it goes up there. And as you can see in our example, let me just get this going. Sorry about that. It went up there. And if you look at the exits here, we ended up closing some of these for $13 and $25. Early on, when the price wasn't moving, we closed some here. We actually, we did a couple of different things here. This trade was a little bit complex. We actually rolled up some of the long calls. We took in some credits there. But we left a couple of the original structures on towards the end. And on the day of expiry, closed one at $13 and closed another one at $25.67, which is pretty incredible given that our initial cost was nothing. The market actually paid us to put it on. We were actually, the first time we put it on, we were actually given $1, then we were given 40 cents, and then we put it on for 0. And again, you may be thinking risk, but I'm thinking chart. So yeah, but is it really going to just in less than a week, is it going to drive through 3780 and not stop? I don't think so. That doesn't make any sense. And remember this as well. If you're in this structure, the risk is not at 37.80. The risk is 80 points above 37.80 because the trade is this. And where would the last wing of the butterfly be here where the risk really starts? 80 points above here. So the risk would really have been at 38.60. So Amazon would have had to have gone from where we started here all the way through and just driven through 38.60, or really maybe on a gap up, in order for this to hurt us. And unless there's a news-driven gap, that's not going to happen overnight. It's going to happen incrementally. And if it happens incrementally, our spread is expanding every moment as we get closer. All right. As we get closer and closer to price, our spread is really, really expanding. Okay. So that in a nutshell is how that worked out. And again, as you can see here, it was a huge winner and it worked out very, very well. There was huge expansion of price. All right. So that in a nutshell is what I wanted to present to you as far as the different spreads, and really just to give you a basic overview of how I trade. The three spreads that I showed you are some variation of used in our weekly options advisory over and over, week in and week out. All of our subscribers know these spreads very well. They're used to them. We use them in many different ways. We use them to collect credit. We use them as parts of risk reversals, meaning we very often will put on an unbalanced on the put side, say 60-cent credit, and then we'll take the 60 cents and we'll move it over to the call side and we'll spend it on some call verticals on the upside if we think the stock is bullish. We use them directionally as well, as I've shown you in the examples here. We'll put something on for 0 and look for it to expand to 75 or 80 cents or whatever. So there's a lot more to it, obviously, but I hope that maybe you can join me in the weekly options advisory and you can see how this stuff happens in real time. Just to give you an idea of what is included, what I offer, you get all of these trades in real time. We do have a mobile app, also through the Pro Trading Room, which is the room that you see here. And you'll see all of these spreads being put on live. I do manage all of these trades from start to finish, along with any adjustments. I'm constantly keeping people abreast of how things are going on. We also do lots of live presentations. So periodically throughout the week, I will go live in our Pro Trading Room to discuss some concepts or answer questions, et cetera, et cetera. We do have a private webinar every week on Thursdays at 4 o'clock where we go over all of the trades that we may have open. We do a big Q&A. We go over a lot of charts, lots of technicals. We look at new ideas for the next coming week. And as a bonus, I do write a market profile newsletter every morning called Peter's Pre-Market Perspective. And that is included free with your subscription to the weekly options advisory. Usually that's $20 a month, but I like to include that free to folks that are subscribed to either the weekly or our time spread advisory, which is our more intermediate advisory run by Mr. Scott Gillum. I like to include the Peter's Pre-Market Perspective because I like to have my traders have a really good handle on market profile and kind of how the day is about to unfold and really start your day off on the right foot. So that's kind of an overview of what I do. Obviously, like I said, it's a little bit more complex once you get into it. Stock selection is very, very important. Strike selection is very, very important. Time to expiry is very, very important. Understanding what's going on is very important. It's not ever a question of just sort of putting on these spreads willy-nilly. You have to really have a good handle on the tempo of the stock, how fast it'll get there. You have to know your technical analysis in the short term, but that is really my sweet spot. And because I feel like that's my sweet spot, that's the arena that I play in. So if you'd like to join us, I would love to have you. It's very reasonable. I charge $49 a month for this. There's never a contract. You can always cancel anytime. We could part as friends if it's not for you. And I hope that you will join me. This is the URL right here. If you'd like to join us, it's shadowtrader.net/options. Or if you're on our homepage, you can just mouse over the options tab and select the weekly options advisory. All right. If there are any questions specific to this particular presentation, you may email me at asktheshadow@shadowtrader.net, and I'll put it into the alerts here if you'd like to email me. All right, if you look into the alert section at the top, asktheshadow@shadowtrader.net. You can send me questions there. And again, shadowtrader.net/options. And I hope to see you. Thank you so much.